Debt funds are a type of mutual fund. They primarily invest your money in fixed income instruments. Think of these as loans. The fund lends money to companies, governments, or other entities. In return for this loan, the borrowers pay a fixed interest. This interest becomes the source of income for the fund, which then gets passed on to you, the investor. Unlike a fixed deposit, debt funds do not offer guaranteed returns. However, they are generally considered less risky than equity funds, which invest in stocks. They offer a stable way to grow your money, making them a popular choice for investors who prefer lower risk and steady returns over the high-risk, high-reward nature of the stock market. Understanding the role of debt funds in your overall investment plan is crucial. Financial planners often talk about asset allocation. This simply means dividing your investment money among different asset classes like stocks, gold, and debt. The purpose is to balance risk and reward. Debt funds provide the stability your portfolio needs. When the stock market is volatile and unpredictable, the debt portion of your portfolio can act as a cushion, protecting your capital from significant losses. For a beginner, starting with debt funds can be a sensible first step. It helps you get comfortable with the concept of market-linked investments without exposing you to the extreme ups and downs of equity markets. The returns from a debt fund come from two sources. The first is the interest income earned from the bonds and securities it holds. This provides a regular and predictable stream of income to the fund. The second source is capital gains. This happens when the price of the bonds in the fund's portfolio goes up. Bond prices can change, mainly due to shifts in the overall interest rates in the economy. When interest rates fall, the price of existing bonds with higher interest rates goes up, leading to a capital gain. The fund's net asset value, or NAV, reflects the combined value of these earnings, and its daily movement shows the fund's performance. So, why should you consider a debt fund? They are a great tool for achieving specific financial goals. Perhaps you are saving for a down payment on a house in 3 years, or for a child's college fees in 5 years. You need your money to grow, but you cannot afford to lose a large chunk of it. A debt fund fits this requirement perfectly. It offers the potential for better returns than a savings account or a fixed deposit, while keeping the risk relatively low. They are also highly liquid, meaning you can easily access your money when you need it. This combination of stability, reasonable returns, and liquidity makes debt funds an essential part of a smart investment strategy. Before you start looking at specific debt funds, the first and most important step is to define your investment horizon. This is simply the length of time you plan to stay invested. Are you saving for a short-term goal, like a vacation in 1 year? Or is it a medium-term goal, like buying a car in 3 to 5 years? Your investment horizon is the single most important factor that will guide your fund selection. Different debt funds are designed for different time frames. A fund that is perfect for a 1-year goal might be entirely unsuitable for a 5-year goal. Writing down your financial goal and its timeline will bring immense clarity to your decision-making process. Once you know your investment horizon, you can start looking for funds that match it. This is where the concept of asset allocation within the fund itself becomes important. Debt funds invest in a variety of securities, each with a different maturity date. For instance, a liquid fund invests in securities that mature in less than 91 days, making it ideal for very short-term goals. On the other hand, a long-duration fund invests in bonds that mature in more than 7 years. These are much more sensitive to interest rate changes and are suitable only for investors with a long time horizon and a higher risk appetite. Always check the fund's investment strategy in its offer document to see what kind of securities it holds. Matching your investment horizon with the fund's average maturity is a simple yet powerful strategy to manage risk. For example, if your goal is 3 years away, you should look for a fund that has an average maturity of around 3 years, such as a short-duration fund. This alignment helps reduce risk. If you invest in a long-duration fund for a short-term goal, a sudden rise in interest rates could cause the value of your investment to fall just when you need the money. By matching the timelines, you ensure that the bonds in the portfolio will likely mature around the time you need to withdraw, minimizing the impact of interest rate fluctuations on your capital. The risk and return potential of a debt fund are directly linked to its asset allocation and average maturity. Generally, funds that invest in longer maturity bonds have the potential to deliver higher returns, but they also come with higher risk. Conversely, funds investing in shorter maturity bonds offer lower returns, but provide greater stability and lower risk. There is no single best debt fund. There is only the best debt fund for you and your goal. A retired person seeking regular income will have very different needs from a young professional saving for a down payment. Understanding this relationship between your goals and the fund's characteristics is the cornerstone of making a smart investment choice. When you start comparing debt funds, you will encounter several key metrics. Let's break down the most important ones. The first is average maturity. As we've discussed, this tells you the average time it will take for the securities in the fund's portfolio to mature. It is a direct indicator of how sensitive the fund will be to changes in interest rates. A higher average maturity, say 5 years, means the fund is more exposed to interest rate risk than a fund with an average maturity of 1 year. You should always look for a fund whose average maturity aligns with your personal investment horizon. This simple check can save you from a lot of unnecessary risk and potential losses. Next, you must check the liquidity of the fund's portfolio. Liquidity refers to how easily the fund can sell its holdings to meet redemption requests from investors like you. A fund should hold securities that can be sold quickly without a significant loss in price. Be cautious if a fund's portfolio has a high concentration of unrated or unlisted corporate bonds. These can be difficult to sell, especially during stressful market conditions. If many investors decide to pull their money out at once, a fund holding illiquid bonds may struggle to pay them back, a situation known as a liquidity crunch. You can find the portfolio details in the monthly fact sheet provided by the asset management company. Another important factor to consider is the size of the fund's corpus, or its assets under management, often called AUM. While a large AUM is not a guarantee of good performance, a very small corpus can be a red flag. A fund with a very small AUM, perhaps less than 100 crore rupees, may face certain challenges. For one, its expense ratio might be higher, eating into your returns. More importantly, a large redemption request from a single big investor could force the fund manager to sell securities at an unfavorable time, impacting the returns for all remaining investors. It is generally safer to stick with funds that have a reasonably large and stable asset base, as they are better equipped to handle inflows and outflows smoothly. These 3 variables, average maturity, portfolio liquidity, and corpus size, form the basic checklist for your initial screening of debt funds. They give you a quick and effective way to filter out funds that are not suitable for your needs or that carry hidden risks. Always remember to look beyond the advertised returns. A fund might show high returns, but these could be the result of taking on excessive risk in the form of low-quality bonds or a very long maturity profile. A disciplined approach that focuses on these fundamental checks will help you build a more resilient and reliable debt fund portfolio for your financial journey. To get a more precise measure of interest rate risk, you can look at a metric called modified duration. While average maturity gives you a general idea, modified duration tells you exactly how much a fund's NAV is likely to change for every 1% change in interest rates. For example, if a fund has a modified duration of 3 years, its NAV is expected to fall by approximately 3% if interest rates go up by 1%. Conversely, its NAV would rise by about 3% if interest rates fall by 1%. This makes it an incredibly useful tool for comparing the interest rate sensitivity of different funds. The higher the modified duration, the higher the risk. So, how can you use modified duration to your advantage? The answer is simple. To lower your risk, choose funds with a lower modified duration. If you are a conservative investor, or if you believe interest rates are likely to rise in the near future, opting for a fund with a low modified duration, for instance, under 2 years, is a prudent strategy. This will help protect your capital from potential losses. You don't need to calculate this yourself. The modified duration of a fund is readily available in its monthly fact sheet. Using this metric allows you to make a more informed decision and fine-tune your portfolio to match your exact risk tolerance. Of course, your analysis shouldn't stop here. There are other important factors that influence a debt fund's performance. One of the most critical is the credit quality of the portfolio. This refers to the creditworthiness of the entities the fund has lent money to, indicated by credit ratings from agencies like CRISIL and ICRA. Funds that invest in lower-rated bonds, often called credit risk funds, offer higher potential returns, but also carry a higher risk of default. Additionally, you should be aware of broader economic trends such as inflation and GDP growth, as they significantly impact the direction of interest rates and consequently the performance of your debt funds. Finally, always follow the basic rules of safe investing. Ensure you complete your Know Your Customer or KYC process properly. Only invest through SEBI-registered mutual funds and intermediaries. All legitimate funds are regulated by the Securities and Exchange Board of India, or SEBI, which works to protect investor interests. If you need more help or have a complaint, you can approach the fund house's investor relations officer. If your issue is not resolved, you can file a complaint on the SEBI Scores platform, which stands for SEBI Complaint Redress System. Taking these simple precautions will ensure your investment journey is safe and secure.